All right, welcome back. This week the market really felt like a pressure cooker, didn't it? We had global tensions and domestic politics both turning up the heat. So let's dive right in and unpack what was really moving the needle for your portfolio.
So here's the big question on everyone's mind. Earnings from companies were actually pretty solid. So why on earth did the tech sector, of all things, take the biggest hit? That's the puzzle we're going to solve. We're going to connect the dots between those big global headlines and what you saw in your own accounts.
Okay, first things first, we've got to set the stage. To really get why the market acted the way it did, you have to understand the major headwinds, both at home and abroad, that really amped up the uncertainty for investors this week.
So out on the world stage, things were tense. You had these persistent conflicts in the Middle East and Ukraine, just keeping investors on edge. And this wasn't just background noise, okay? This was fueling some serious concerns about oil security and just kind of tamping down the market's overall appetite for risk.
Then you bring it back home to the U.S., and we had a partial shutdown of the Department of Homeland Security, adding a whole other layer of complexity. It was basically a political standoff over immigration reforms, and it just threw another dose of policy uncertainty right into the mix.
And speaking of tension, President Trump took a very hawkish stance on Iran, deploying a second aircraft carrier, the USS Gerald R. Ford, to the region. Well, that sends a pretty strong signal about potential escalation, and the market noticed, immediately slapping a geopolitical risk premium on things, especially in the energy sector. Meanwhile, over at the Munich Security Conference, you had Secretary of State Rubio working to reassure our allies in Europe about America's commitment to Ukraine and NATO. Now, what's fascinating here is the dual effect this has, right? On one hand, it's a green light for spending in defense and cybersecurity. But on the other, every new statement adds a little more headline risk for the market to deal with.
Okay, so that's the backdrop. A whole lot of pressure and uncertainty. But how did the market actually react to all this? Let's get to the numbers and see how these headlines translated into real-world results.
The Dow, which tracks 30 of the biggest U.S. companies, saw a pretty notable drop of 1.2%. You could tell investors were really weighing all these risk factors, with the index of these so-called blue-chip stocks closing just over 49,500.
The broader S&P 500, well, it fell even a little further, down 1.4%. Now, this was the fourth down week for the S&P in the last 5, but, and this is important, the drops have been pretty gentle. It feels more like an orderly cool down than a full-blown panic.
And that brings us right back to where we started. The tech-heavy NASDAQ. It led the way down, falling a pretty sharp 2.1%. No question about it, this part of the market felt the most pressure from that shifting sentiment.
So why? Why the big drop in tech? Well, here's what wealth managers are saying. The key theme to understand is that this isn't about bad performance or weak earnings. It's really about sky-high expectations. When valuations get that stretched, stocks just become super sensitive to bad news. Any little shock, whether it's geopolitical or political, can be the trigger for investors to say, you know what, I'm taking my profits. And when everyone is piled into the same popular stocks, you get a quick reset like this, not a fundamental collapse.
All right, let's get a little more granular now. The market as a whole was down, sure, but that doesn't tell the whole story, not by a long shot. It's time to pop the hood and look at the specific companies that actually thrived and the ones that really struggled.
Man, it was a real tale of two markets this week. I mean, look at this. You've got Generac up a staggering 22%. And on the flip side, the commercial real estate giant CBRE Group is down 16%. It just goes to show you these companies' specific stories were the real drivers of performance.
And this is a perfect example of that direct link between the headlines and your stocks. Texas Pacific Land, it makes money from oil royalties, so it surged on all that tension in the Middle East. At the exact same time, CBRE Group slumped because of those nagging worries about commercial real estate and what higher interest rates are doing to that sector. See? Direct connection.
Now, underneath all this daily up and down, the bigger economic story, inflation, is still playing out. And this is absolutely crucial to watch, because it's what dictates what the Federal Reserve is probably going to do next with interest rates.
So, the latest report we got, the Consumer Price Index for January, shows that inflation is still slowly but surely drifting lower. Headline CPI came in at 2.4%, and core CPI, that's the one that strips out the crazy food and energy prices, hit 2.5%. That's actually its lowest point since way back in April of 2021.
So, what does this all mean? Well, this data really supports this idea of disinflation but not done. In other words, things are cooling off, but the Fed's job isn't quite over. It keeps the hope for a rate cut around the middle of the year alive,
but it also hints that we might be in this higher for longer but peaking phase for rates, and that can create some choppy waters for the market in the short term.
Okay, so after a week like that, where should a smart, busy investor like you be focusing your attention? Let's put together a quick watch list for the week ahead.
There are really 5 key things to keep an eye on. First, listen for any speeches from the Fed for clues on rates. Second, watch for new economic data, stuff like retail sales and housing. Third, we've still got a few big tech companies left to report earnings. And you'll also want to pay close attention to reports from financial companies on how credit quality is holding up. And of course, any commentary from the energy and defense sectors, given everything going on. This is where the next chapter of the market's story is going to be written.
So, here's the bottom line. If you can't watch the market every single second of the day, do not panic. A really sensible strategy in this kind of environment is to just use dollar-cost averaging. That just means investing a set amount of money on a regular schedule into high-quality, big companies. The goal here is to stick with a long-term plan, not try to time the market based on every scary headline.
And that really is the big strategic question this week leaves us with. When you're faced with this kind of volatility, do you pull back and trim your risk, or do you have the conviction to stick to your long-term plan? That's a question every single investor needs to answer for themselves.